Hello, everyone. Welcome to another lovely episode from JayFx. This is the episode 8 of the Elliott Wave Mentorship, and this is going to be a live analysis prediction of GBP USD. Like I made mention in the previous episode, we have concluded the breakdown of what these things are. Okay, so when I'm going to be explaining these methods, it's going to not sound strange to you. If you have not understood this, then that means you haven't watched the previous episode we made on this particular series. So please head back to the channel and go visit the episode 1, 2, 3, 4, 5, 6, and 7 to get to where we are right now, because I will be explaining some advanced stuff, that is assuming that you understand a little bit of smart money concepts, because that's like the regular method we use on this channel. And then I'll be adding Elliott wave analysis to the picture, understanding and assuming that you have gone through those particular series of the previous episodes. So please go back and make sure you understand what we explained in those episodes, so you can also have an insight of how I make this analysis, and then you can try it out yourself and then trade for yourself. So as you can see on the chart, we have a bullish prediction for GBP USD. This is the impulsive bullish wave of the 4-hour time frame. That is this, which is identified with the black one here. So every other wave identified is within this wave. So those are the internal structures we're trying to break down using Elliott wave method. Okay, so the overall direction is this, and that is basically what the market structure, as you can see, is currently doing. So the prediction is in line with market structure, and it makes sense because you understand, I told you all methods are crafted out of market structure, and if you understand market structure, it's going to be easier for you to predict using smart money concept, Elliott wave, Wyckoff, whichever method you're familiar with. So as you can see, the trend we are predicting is bullish. And now the confirmations, or we can say the confluence breakdown of this range that we're using to support this prediction, is what we have as the internal structure analysis. Okay, so basically we are saying we identify this as a bullish impulsive move, as you can see. Now, there's something you need to understand. What I explained from the previous episodes about impulsive and corrective structures, those patterns, we understand 1, 2, 3, 4, 5 is an impulsive pattern, and ABC is a corrective pattern. But correction is this, okay? And what's impulsive? So this is an impulsive move, and this is a corrective move. So those ABC patterns are patterns you identify with corrections, and those impulsive patterns are patterns you try to identify with impulse. So when you see a pattern like this and you can't clearly see the 1, 2, 3, 4, 5 below it, you can now use the criteria of identifying an impulsive move. Okay, so how much time was wasted for this candle to get to this candle, like within the range? If you're familiar with impulse and corrections, you know what I'm trying to say. So you notice that this is an impulsive move, rally base rally. You see, it's not really on a range. And at the same time, if you look at this, you can see we spend more time here. So this is a correction. So in line with market structure, because remember we identified the trend is bullish. So if the trend is bullish, then the trend has to be on the bullish side, not the correction. So as you can see, the impulse is bullish. So impulsive and corrective terms also go into the patterns. So they say it's a corrective pattern, and you're trying to look for it at the point of a trend. You're supposed to be looking for the corrections at the retracement, because corrections happens as retracement, and impulse happens in the correction of the trend, in the direction of the trend, sorry. So with that understanding, you understand why I call this a 1, even though we can't clearly see the 1, 2, 3, 4, 5, which is the pattern. But this is an impulsive move to the upside. So this will be identified as the 1. And then at the breakdown of the 2, you can clearly see the ABC pattern within the correction. So this is also a correction, as we can confirm that the trend is bullish after we had the break of structure of this high. So the trend is bullish, and this is a correction, okay? And also, this low did not go below the range of wave 1, which is a criteria of confirming this is a 2 and this is a 1. So we also use those kind of principles I explained for you guys on episode 2 to identify the waves. So it's not like you're just going to your chart and trying to identify A, B, C, D, 1, 2, 3. You have to make sure those things make sense. That's why I said watch the previous episode so you can understand what I'm trying to explain. Okay, so then we move to wave three. We also look into the criteria of wave three. Wave three cannot be the shortest wave. We can see wave one, we can see wave two, wave three, and we can see that wave three is clearly longer than wave one. But at the same time, we haven't seen wave five. So this also gives a disadvantage to this, as we can clearly see that the wave within wave three is kind of like a impulsive wave pattern. It's a pattern that is common. Okay, this is going to be displayed on the screen during the editing period. But at the same time, you should understand that a wave four going into the territory of wave one is a pattern too that is identified as an impulsive pattern, but it's not that common. All right. So, but at this scenario, this is what we see. This is what we can see, and then that is what we can identify. But we can also identify that wave one and wave five of the wave three structure are also impulsive. So which also confirms that this is an impulsive wave, even though it doesn't make much entrance to what we call a 1, 2, 3, 4, 5 regular pattern. Okay, the basic pattern I explained for you guys. This particular pattern was not broken down in a single episode, but you should also understand that there are multiple patterns that can form, and the criteria are more important than the patterns formation. Okay, so moving on to wave three. Now we see wave four forming, and then we use what are the criteria of a wave four. It cannot go below the territory of wave one, right? That's to say this point. So what we are saying is that wave four basically is not supposed to go below this support level. So this support level is supposed to hold the trend if this analysis is correct. Okay, so that's how we ended up with, we are bullish because using Elliott wave to break down the range, following the trend because we know the structure is bullish, we clearly also see that we have the criteria as matching with a support level, which is a confluence for the entire analysis. Although you see a demand zone on my screen, I'm not giving you any breakdown on that. I'm just giving you insights to what we have as the Elliott wave analysis. Then I will break down that for you so you don't get confused, okay? So, but right now, I just give you insights to what's happening within the range and the confluence to how we ended up with this 1, 2, 3, 4, 5, and the breakdown on the lower time frame structures. So this is how Elliott wave analysis work for me. This is how I use it. I don't just separate them individually and say, since I'm using Elliott wave, I'm not going to look for things related to SMC, or these are different patterns. I should try and differentiate them, stuff like that. No, what I do is that I use them as confluence, and I add multiple methods to make sure that my prediction is likely to go in my direction, because the more they are aligned together shows that your analysis might be correct. Okay, so it increases the probability of you being right. So what we have here is basically also telling us that we have a demand zone at this point using smart money concept. And also we can see that this could be identified as the liquidity of this demand zone. So also we can also see that this is also in a more discounted price of this newly formed range. So this is discount, and then that's premium. So at the same time, price could decide to go lower to a more discounted price. But right now, what we have on the screen is telling us that this also is a structure, and this low hasn't been broken yet. Okay, so at the same time, there's also a possibility that this structure could hold and then price go bullish. So what is our final conclusion? This is that if this doesn't hold, the next area of interest should be this demand zone. It's as simple as that. If this doesn't hold, look for a bearish entry and right towards this demand zone, because this will be cleared out. This will be liquidity. This is saying probably the higher time frame analysis of the Elliott wave was wrong, and this 1, 2, 3, 4, 5 was not identified correctly. Not the internal structure though. Internal structures can always be correct. If there's something wrong with your analysis on Elliott wave, it's probably because what you identified on a higher time frame was not correct. And then as you can see, I never went to the daily. I'm just giving you guys a breakdown of what I see on the 4-hour time frame. So if something happens, that means this resistance level is coming from a daily area of interest, and that happened to invalidate what was below the lower time frame. So I told you the bigger the wave, the more stronger the effect. So this could be an A on a daily time frame, and then price could basically be expecting a B here, and then something like this happens, and then price goes bullish. So this now supports the narrative, this ABC supports the narrative that the daily time frame could be bearish, the daily time frame could be bullish, sorry, and price could actually be traced to this particular area of interest. So we have two areas of interest, which is this support level and this demand level. And that's what we have for this range. So now this brings us to where are we right now on the chart? So if we look at the chart right now, we are currently at the wave B of the ABC of this wave. Okay, so what we want to see is this wave impulsive? Was this wave corrective? And is this wave impulsive? That is to confirm that this is a zigzag pattern and it's likely that price is going to be reacting off the support level to give confluence to what is going on the higher time frame. Okay, so when you understand this point, would also give you insights to what you should do if you happen to be wrong, and then you have this as a point of interest, and then instead of following this other prediction, you go for something like this. You see, and then you write price, off the support level to the lower time frame. So that's basically what you do if this is not correct. This is like saying what you should do if you happen to be wrong on the support level holding, because this is all predictions, okay? In as much as you could be very, very logical and you could be very, very convinced that you're correct, price could decide to go the other way around following the other possibilities. So don't be egotistic about your prediction. In as much as you follow the rules and regulation, you can still go wrong. So this is like a plan B, that is to see the reaction of this particular support level. And also this other block over here is also reacting off a weak low. So this is a weak low. So we're expecting this to fail. As you can see, it failed to clear out this high. So this is a weak low. So this is also seen in SMC as an inducement. All right. So there's every tendency that price could go bullish and the first prediction could be correct. So what we are doing is like giving a possibility. What if we are wrong? So what you just understood now is that SMC can be used with Elliott Wave. Elliott Wave can be used with support and resistance, and you can also even add confluence of Wyckoff. All you have to do is just make sure your chart stays simple and you understand what you're doing. Okay, it's all about logic. And you can also join the community on Telegram where we share chart analysis on a regular basis, and other analysts to share their chart. You can use that to, confluence what you're doing and also make more sense before you make your predictions. Normally, if I was to trade this, I could easily just do something like this and place my stop loss below this for better confirmation if I was being impulsive. And then this would be my basic prediction. And that entry at this point, SL at this point, TP, that is done. And this could go, a long way, because this is about 200 and something pips. You see, so trading is that easy if you know what you're doing, and you can easily do it yourself. You don't have to pay for signal service and all of that stuff if you know what you're doing. Okay, so on the episode 9, we're going to dissect what happens after this analysis plays out, and also, basically do a different analysis and see what goes after that point. Okay, so thank you for joining us. Please subscribe and leave a like if you find this video educative. We break down technical methods of trading the Forex market and also help you to gain insights to what will happen next. Okay, thank you and see you on the next episode.